Thanks so much for joining this session at Best Ideas 2014. Delighted to have with us Chris Karlin, Chief Investment Officer of Aquitania Capital Management. Chris has been in the investment business for more than 20 years. Prior to founding Aquitania in 2012, he was at First Pacific Advisors, Kestrel, and Fairview Capital, as well as at Farallon as an intern while pursuing his MBA at Yale University in the late 90s. So a lot of perspective from different firms, from different value investment approaches. And today, as you can see on the title slide here, Chris will share with us his investment case for Kimra. It's an equity that's down significantly over the last few years, and really look forward to Chris's investment case for it. And without further ado, Chris, please go ahead.
Thank you for the introduction. It's a pleasure to have the opportunity to present at the 2014 Best Ideas Conference. And we're going to discuss Kimra today, and hopefully in the process also give some insight into how we approach investing. So with that, here's the Don't Sue Us slide. And just a brief overview of Aquitania Capital. We're an opportunistic value investor. And I think what really distinguishes that is that we're seeking to invest in situations where there's a large divergence between probable risk and perceived risk. And so our analysis begins with focus on the downside. And I think that is not entirely unique, but it's what characterizes being opportunistic for us, is situations not so much where the return is going to be outstanding, but where the risk profile is highly asymmetric and in our favor. And with that, on to Kimra. Kimra is a mortgage REIT. It was formed in 2007, and it's managed by FIDAC, which is a wholly owned subsidiary that also manages analytical capital. And the very brief history was they came out, they launched an IPO in 2007 to raise money to invest in non-agency mortgages. So these are mortgages that are not guaranteed by the federal government, or I should say implicitly guaranteed by the federal government through Fannie Mae, Freddie Mac. And so you actually are, your returns are driven by credit risk. So they came out in 2007. Which was a great time to raise money to invest in mortgages. It wasn't a particularly good time to actually invest in mortgages. And between 2007, when they went public, and the end of 2008, I think they were down about 70%. And the story probably would have ended there were it not for the strong goodwill in the investment community associated with analytical capital. And Mike Farrell, the late Mike Farrell, who was the CEO at Annaly and basically founded the mortgage REIT industry, this allowed Kimra to go and issue subsequent equity and raise additional capital. And then going forward from that point, they've been very astute at managing that capital on the investment side. They invested between 2009 and 2011, and they bought a lot of securities when there was great anxiety and trepidation in the market, and they got some excellent prices, certainly in hindsight, but I think even at the time, I'm guessing they probably knew that they were getting very, very attractive prices, and that has set the stage for what's an interesting investment opportunity. So again, it's non-agency residential mortgages. They are prime securities. They're generally, these are more like Alt-A, which would be generally non-conforming because of size. So these are single-family residences, high dollar balances, high credit scores, not excessive loan to values. What it's also is equally important is what it's not. It's not subprime. It's not option arm or pick a pay. The stuff that really blew up in the downturn and never recovered necessarily. This is a prime portfolio. It's basically dominated by exposure in California, in the Washington, D.C. area, some New York. So it's Florida. It's expensive homes on the coasts that are financed with mortgages that are outside of the $400,000 to $700,000 mortgage guarantee limit. And so they're managing this portfolio with very little leverage. They have an agency book which is sort of there for regulatory purposes. There's a 40 Act compliance issue that forces them to have an agency book so they don't get regulated as an investment advisor. That agency book has some leverage on it of about 2.5 times debt to equity, but overall the non-agency book is completely unleveraged. So in aggregate, the leverage is only 0.5 times debt to equity. So you're not really assuming financial leverage here that's significant. And there's great structural leverage because what they did is they took the portfolio securities that they had acquired and they did securitizations with them. In some cases, these were re-securitizations of mortgage securities. And effectively, that was a financing transaction for them. The best way to look at it is the analogy of a developer who might buy a large parcel of land, subdivide it into lots, sell off the most attractive lots for which there's high demand at attractive prices off to other parties, and be left with some of the second-tier lots. But because of the mechanics of the transaction, they're able to retain those pieces at very low cost. It's selling off the prime pieces for which there's greater demand effectively covers their cost of the entire transaction. And so they were able to do that, and that leaves them with a portfolio that is, as the cash waterfalls through these securitization transactions, it's going to increasingly be redirected towards the subordinate and mezzanine tranches that Kimera owns. And because these securitizations occurred in 2008 through 2012, they have aged enough to where that waterfall moment is really upon us now. And we think the cash flow acceleration at Kimera is going to be significant over the next couple of years. So effectively, you have a very levered upside to improving housing market without significant downside exposure. And most notably, you don't need housing to be super strong in order for this to work out. What you need is for housing not to, enter into a new downturn of significance. That's really the main way in which you lose, and we just don't think that's very, very probable. You can see the market capitalization and is about $3.2 billion. There's about 1 billion shares outstanding. It's trading about 1.1 times to book. I should mention that today is the ex-date for a special dividend that they declared of 20 cents a share. So the figures shown in here are based on the closing price of $3.14 as of last Friday. So how do we view Kimera? We effectively view Kimera as a closed-end bond fund selling at a deep discount to net asset value. And it's closed-end because they are delinquent filing. There was an accounting issue relating to how they treated losses in the portfolio, which we'll go into a little bit more detail later. Effectively, the executive summary is that these were not issues relating to management integrity, and these were not issues where materially distorted cash flows or book value. It's really a difference between how you handle losses. Do you flow them through the income statement, or do you flow them through the income statement for some, and for others flow it directly through equity? And it's mortgage accounting is interesting stuff, and we'll discuss that a little bit later. But we believe that the delinquent filer status and the issues surrounding it are mostly behind them, and in 2014 this should disappear as an issue, and we think it's going to be a big catalyst for the stock. We say it's closed-end because so long as they're a delinquent filer, their hands are tied in terms of not being able to do the things that REITs tend to do that are disadvantageous to equity holders. REITs, by virtue of being forced to pay out 90% of their taxable income as dividends to get the tax shield, they typically they can't grow through retained earnings like a C corp, so they have to periodically issue equity if they want to grow. Well, if you are a delinquent filer, you can't issue equity very easily. You have to do a long form. So basically, they can't issue equity and dilute shareholders until they have been a current filer for at least a year, and that's a fair bit out. So they can't really do anything that you feel that can be adverse to your interests. That is the case when you're looking at most REITs in general. We also believe their calculation of economic book value is highly conservative. Their treatment is effectively it's very appropriate if you were going to set up a private pool, a private fund, and you say, okay, we're going to lock this money up. We're not going to let people enter and exit, and we're going to basically mark things, very conservatively until we actually realize whatever value we get. And that's exactly how I do it if I was running a private fund. It's a little bit more complicated when you're a public company because people are able to trade in and out of the securities at any given moment, and so you'd like them to have a more accurate value of what the economic value of the assets are, but that's really, it's really challenging to do given the type of collateral they have. These are private, non-rated, subordinate and mezzanine tranches of mortgage securities. They're not terribly exotic. There's just not, a liquid market for that, and that creates a wide latitude of discretion for management in marking that portfolio. And to reiterate, we think highly of the integrity. Their integrity of management has not been called into question. Nothing that happened with the restatement was to benefit management on a personal level. So that's, to make that explicit, we don't think there's an ethics issue or an integrity issue here. It's just a question of having a lot of latitude on how you mark the merchandise and electing to be very conservative. And I don't think that's a bad thing. So we don't see a lot of risk here. It's a very deep discount to net asset value. It's virtually unlevered, so you don't have risk from blowing up because they're levered, 7 to 1. You're not dependent on continued housing improvement. Management's restrained, And we have catalysts. So the catalysts that we expect to see this year are, as I mentioned, delinquent filing status should disappear. The cash flow waterfall on the securitization deals should, really start to flow in their favor. And I think we've already seen that in 2013. You have a large interest-only portfolio, or it's a large portion of their portfolio is in interest-only securities that were created with the securitizations. Interest-only securities have negative duration, meaning that their value rises along with interest rates as opposed to conversely to interest rates. We expect that all things equal, that type of portfolio probably will have increasing value over the next several years. We don't necessarily, if we had the ability to predict interest rates, we probably wouldn't be on this call right now. But at least directionally, we feel comfortable that rates are much more likely to go up than down. We also think there's a final catalyst in a possible takeout, and Annaly is the most likely acquirer. There was a company called Crexus that Annaly set up, similar to Chimera. Crexus was set up to invest in commercial mortgage-backed securities, and ultimately Annaly purchased them in late 2012, brought them under the fold. And so we think Annaly might very well like to do the same with Chimera. It's not central to our thesis. In fact, it's actually one of our risk factors because we fear that they might try to get it at a lower price to capitalize on the lack of understanding about the true value of the portfolio in the marketplace. But it's certainly a catalyst towards starting a discussion of what Chimera should be worth. So why could Chimera be mispriced? Well, I think we've covered most of these. They're not current on the financial statements. They are technically they're getting delisting notices. They are a $3 billion company. They've been making progress. They filed their 2011 10K. This issue came up at the end of 2011, at the third quarter of 2011, when they reported this came up. They filed their 2011 10K in March of 2013. So they had, a year and a half delay in making that filing. But since then, they have filed for all of 2012, including the 2012 10K, which was published the last day of 2013. So they are technically a year behind, but they're making progress and should be out of the woods on this. So the delisting is something that spooks investors, but we think it's a lot of perceived risk. We think there's really no risk of the delisting, and in the worst case, if they delist, so what? It's going to trade somewhere. It's just going to go to the NASDAQ. They have not been communicating with investors. And for a couple of years now, they are starting to talk a little bit more through the issuance of some presentations. There was one that was issued in October, which gave more detail on the portfolio than we had seen in a couple of years, and it all supported our thesis, but there's been very limited communication. You have the GAAP accounting treatment wildly deviates from the underlying cash economics. It's a low-price stock, and it's in an industry that's trades somewhat monolithically along with the agency REITs, and yet they're very different. As far as macroeconomics go, the government's, the Fed's relief program, their bond buying program has included government securities. That's treasuries. It's also extended to include government guaranteed mortgages, Fannie Mae, Freddie Mac, agency paper. So in late May, when Chairman Bernanke sort of stated what should have been rather obvious, that hey, at some point the party's going to end, and we're going to taper off our bond buying. The agency market understandably got hit because the people could see that at some point we're going to lose the government's bid on these securities. But the government's not purchasing non-agency securities, so there's no direct linkage there. There certainly is indirect linkage to the extent that investors that own agency securities sometimes also own non-agency securities, and what's happening to them on the agency side of their book might impact how they trade their non-agency part. But by and large, these securities trade monolithically, and they're really rather different animals. Also, the agency mortgage REITs tend to be really highly levered, and Kimmerer is not. So what are you getting when you buy Kimmerer? So there's two facets to the portfolio. There's a total portfolio value of $4.7 billion as of June of 2013. As I mentioned before, there's an agency portfolio which is about 45% or $2.1 billion that is really there to maintain the REIT registration and the 40 Act exemption. You've got financing on this part of the portfolio at modest leverage, and it's really, the returns on Kimmerer aren't going to be driven by this. They've earned decent returns on it. They've earned probably ROEs of like, low double digit, probably 10, 12% ROEs on this with the leverage. But it's really not the main driver of returns. The main drivers, as we mentioned, the non-agency portfolio, and we talked, I think, enough about that portfolio. So the accounting issues. So basically, GAAP is really interesting to put it politely, for mortgage securities. So if you have investment grade securities, or securities that are considered investment grade, you follow one accounting treatment, which is to say that you will periodically, say quarterly, estimate what you think your future cash flows are, and you will decide if the present value of those cash flows is less than what you're carrying the security at, you will recognize a loss. Now, what's important here is that it isn't tied to actually experiencing a loss. It's just your forecast that you might experience a loss. So generally, you are making adjustments on securities that may very well have been performing perfectly well. But in any case, with an investment grade security, you make this assessment and you flow the loss through your income statement, which is where you would do, that's what most people expect. And what happened to them in late 2011, their auditor at the time, Deloitte, came to them and said, presumably, this is fine for your investment grade securities, but we want you to treat your non-investment grade securities differently. And what they effectively want you to do for non-investment grade securities is to flow that loss, this actuarial loss, this forecast loss, not an incurred loss, but a forecast loss. We want you to flow that through your equity, through the statement of other consolidated income, and not through the income statement. Okay. So what's the impact of that? Well, the impact of that is it's going to change your taxable income because you've shifted losses out of income and put them directly to equity. But losses that go through income ultimately end up impacting equity. So have you impacted your book value? No. Does this impact your taxable income? No, because taxable income is accounted for as different than GAAP income. You basically, in taxable income, you just recognize your cash flows as they come in. If you actually experience a loss, then you recognize that loss. And if things improve, you can reverse some of that loss as you go forward. So taxable income's a little bit more intuitive. Does it impact your cash flows? No, not at all. No impact on cash flow. So it really just affects taxable, or not taxable, GAAP income. It does not impact book value. It does not impact cash flow. It does not impact taxable income. And so what you have to do when you, well, actually, let's back up for a second. So why might this have happened? Well, if you think back to where the world was in third quarter 2011, and this is, I should say, is speculative on it's a personal opinion, but third quarter 2011, there was a lot of risk about Europe. The bond market took a big dive, and I think people were worried that, oh, here we go again. It's going to be 2008, 2009 all over again. The equity markets took a sharp downturn as well, and we think somebody at Deloitte, and again, this is entirely our speculation, somebody at Deloitte probably got spooked and said, listen, we want to, we don't really want to be associated with anything that blows up again. And what's interesting, you look at these accounting statements that they were being asked to implement. We've searched through all the SEC filings for all companies, and textual searches for these. There's only like one or two companies that's using the same treatment. It doesn't appear to be standardized, but that's getting a little outside of my pay grade to explain why this is happening. But the important part is that it they said, okay, we'll do this, but this is a big deal because you've got to go and perform the impairment tests for each CUSIP. You've then got to redo your losses, and redo all your accounting on a CUSIP by CUSIP basis. And we're talking again about private non-rated securities, so it's not just like you call up your broker and say, okay, what's my mark? There's not necessarily a market for it. So where do we stand now? So at the last day of oh, there's actually a typo in the slide. The 2012 10-K was filed 12/31 of 2013, not 2012, as shown there. They have a new auditor that came aboard early last year, I think March of last year. So that slowed the process a little bit because they had to have Deloitte did the 2011 10-K, and which was filed in March of 2013, and then they had Ernst & Young come in and start basically from scratch from January of 2012 going forward. So that took a while, but they filed their 2012 10-K with the new auditor on the last day of 2013 with an unqualified opinion on the financials. The auditor identified material weaknesses in their internal controls, basically saying, you didn't have the resources or the processes in place. You were relying a lot on spreadsheets, and management, stated in the 10-K that they implemented resources and processes to remediate these weaknesses in internal controls during 2013. So it's our interpretation of that going forward, there should be a smoother path towards getting current on their filings. We hope, but the expectation is that in 2014, hopefully they will become a current filer, and this will no longer be a cloud over the company. Cash economics of the business. So well, this is just a little bit of silliness. So the Oxford English Dictionary defines chimera as there's one definition of it is a thing that's hoped or wished for, but is in fact illusory or impossible to achieve. And we think that's also a very accurate. There's an alternative definition of accurately conveying the economics of private mortgage portfolio of subordinated securities via GAAP is also something hoped or wished for, but is in fact illusory or impossible to achieve. The accounting, as we mentioned, it doesn't really relate to the cash economics. The But what we do know, what gives us comfort, is that when they purchased these securities, most of these underlying securities in 2008, 2009, 2008 through 2011, the market was in great disarray. They were able to purchase this portfolio using what they have deemed in their conference calls as draconian loss assumptions, which were made sort of in a moment of crisis. What they do is they estimate their fair value for the securities. Then they call up the brokers and say, well, give us a bid ask. And the broker will get back to them and give a bid ask. And because these are private securities for which there's not really an active market for, that bid ask spread might be 20 or 30 points. And if the management estimate is within that quote, they go with their estimate. If the management estimate is outside the broker quote, they'll probably adjust it. That's how the portfolio gets marked. And so does it offer? It offers an awful lot of latitude to management. We believe that this management is ethical and that they have elected to mark the portfolio very conservatively. And the reason is ultimately incentives. There's no promote on this. There's no carried interest. Annaly, prior to the accounting issues, was getting 150 basis points off of equity a year. They've modified the agreement to take half that rate, or 75 basis points of equity, until the accounting issue is behind them. So there's no performance interest where you'd say, hey, let's really juice up the asset values so that we get paid more. That wasn't an issue. And if you think about it, the risk of marking up a portfolio before you've actually realized the gain is that it might revert and you'd have to mark it back down again. And you can see why a lot of people would say, hey, let's just mark it conservatively until there's an event, a monetization event. And generally we support that. That's how we would do our portfolio. So the GAAP earnings they don't really relate to the cash flows because they're driven by amortizations and they're driven by these forecasted estimates as opposed to actual experience of the portfolio. And so we just don't really focus on GAAP earnings. We tend to look at ultimately what we think the underlying collateral is doing. So book value we think grew about 6% in 2013, which is pretty good for what was a rather difficult year for mortgage investors. So since we can't actually see the portfolio trade in the market, we believe that it's undervalued. How do we validate these economics? So we can look at the monthly reports that are issued on the securitizations. We can see how the collateral is performing. We can look at indices of other other non-agency paper to see the price visibility there. We can intuitively look at what's happening, what the state of the housing market is, and we also listen to and speak with other investors in the space to get a sense of what the collateral, the portfolio might be performing. So the underlying collaterals performed well. So this is a slide actually lifted from Kimura's presentation in October, which covers through June 30th of 2013. And basically the takeaway here is that the portfolio is aging well. And again, you can see that as you would expect intuitively, delinquencies have fallen. Prepayment rates are relatively steady. Prepayment rates probably will start coming down a little bit as interest rates rise because people won't be able to refinance out of, it'll no longer be attractive to refi. We can also look at the underlying securitization collateral, again, through these monthly reports, and it just supports the data. I don't think there's any great secrets uncovered by these graphs. They just sort of show what you would expect, that the portfolio is aging well. This is prime collateral. Real estate owned is going down. Foreclosures are going down. Delinquencies are going down, and certainly, it is steadily, paying off. We can also look at the AVX indices, and this is actually, I think, only through sort of mid-2013, because market has decided to stop providing the index data to Bloomberg, but effectively the performance there has been solid. This is for paper that was issued in 2006, 2007, has all done really well. This is lower tier, which is more likely to target or more likely to match up with the subordinated mezzanine tranches that Camera owns. So what are the outcomes here? Our null hypothesis is that the reported book value is representative of economic value. So we think it might have a book value of $3 a share. So we're trading just maybe about 1.1 times book. But yet when you buy these securities, you accrete at a discount. You accrete you create what you call an accreted discount, which is what you forecast at the time of purchase to be the expected recovery. Now, you don't put this anywhere on your balance sheet. It's in the footnotes, though. And so, they're carrying, as of December 2012, which is the last figure we have for this, they're carrying $2 billion in accreted discounts. And this is on a portfolio that at the time they were carrying at about $2.3 billion. So there is a large amount of accreted discounts that they expect, and you adjust that based on your forecast. So they still expect a pretty substantial recovery to occur on the portfolio. So we think that it's, even if the book value is representative of where the economic value is today, we think there's an awful lot of latent growth in the portfolio over the next several years. Our variant hypothesis is that the reported book value dramatically understates economic value. And again, this is just reiterating all the things that we've shown already. That the collateral has improved far more than the growth in their book value that they've shown on the portfolio. The market pricing has also risen faster. We all know, the state of the housing market has improved. And also keep in mind the loss assumptions that are embedded in that accreted discount of $2 billion, are very conservative or draconian in their words. So this is what we think the portfolio looks like as of June 30th. And the items in blue are going to be our estimates. So, we think that they're probably, sitting on a total portfolio, including the agency securities, carrying at about $4.7 billion as of 6/30. We should note, and I think we'd say that you're probably looking at about maybe $7.5 billion face on that portfolio. So we're trading at about 60 cents sort of a share in that range. So we think that is sort of where they're at. Well, what's interesting here is the securitization waterfall that we mentioned. So they came out in October with some data that we hadn't seen before. And so it showed the securitizations as they, stood at origination, and also how they stood as of, and I'm sorry, there's actually a typo in there. That should be as of June 30th, 2013. So what's interesting there is that the remaining faces of the tranches that they've retained is a very high percent of the remaining face outstanding, which means that the cash flows, so the way this works is you securitize, you take this pool, you cut it up into tranches, you sell off the prime tranches. Those get paid first. That's held by other investors. You retain the stuff that gets paid later. Well, later is now. And so what we're seeing is that the remaining face of the tranches retained is a large portion. It is, for the securitizations that occurred between 2008 and 2010, it's 70% of what remains, which means as the cash flows continue to come in every month on these portfolios, it's going to increasingly be redirected towards the securities that Kimra owns. And so we think that's really going to accelerate cash flow in the coming years. And even on, when you include the ones that were done in 2012, for which we don't expect them to see significant cash flow for the next couple of years, even on a consolidated basis, you're looking at 60% of the remaining face is represented by the securities that they hold. How we look at valuation. So what we think, this is as of December of 2012. We're starting from that because that's where we have sort of more complete data. So we think that you're looking at a portfolio that had a notional value of about $8 billion. They bought it for the equivalent of 24 cents on the dollar. They're carrying it at 29 cents on the dollar now. We shouldn't expect a par recovery because of the interest onlys, that big senior piece of interest onlys. Interest onlys, you're not going to get a par recovery, so it's misleading to think that you're buying this whole portfolio for 20 cents on the dollar. But for the sake of argument and clarity, it's handy for us to sort of describe it that way. So they've got 8 billion face. They were carrying it at about 2.3 billion as the end of 2012. Our estimates, even from the low and the high side, are pretty conservative, and we can see how you have perhaps easily 25 to almost 50% upside from here. But again, what we think makes it most attractive isn't so much that the upside is excessively high. It's that we really have a hard time envisioning the downside, and that's what gives it the very asymmetric reward to risk profile, and what makes it one of our larger positions. We really like how it's the outcomes are heavily slanted in our favor, and we think possibly we could certainly envision a scenario. We've worked through some scenarios where we think we could get additional upside to that number, but it's for conservative presentation, we're very comfortable in that range of that sort of upside. And with the catalysts that we see coming forward with the, we're gaining their filing status. We think Annaly is likely to make an offer for them once the financials are clean. We don't think they can do it, in advance of that. What's really interesting about this is that Annaly, or FIDAC, which is the management company that manages both Annaly and Kimra, because of the accounting issues, they redid their contract, and basically they redid the contract to say, okay, that FIDAC is going to pay for all the cleanup costs on the audit. FIDAC is going to cut their fee in half until this issue is resolved. But the third and probably the biggest issue is they said, we're going to let you basically fire us at any time without explanation until this is resolved. And where that gives shareholders a lot of leverage is that, if Annaly comes in and wants to take advantage of, the misperceptions in the market about Kimra, it's going to be very hard to get away with a lowball offer, because shareholders always have the option of standing up and say, hey, you know what? Why don't we just terminate your contract, and we'll turn the portfolio over to BlackRock or PIMCO, and let them just run it off and pay 30 to 50 basis points a year just to have somebody collect the coupons and process them. That gives a lot of leverage in terms of shareholder leverage with respect to any buyout offer that comes out. We mentioned the cash flow, that we think that's going to be a big catalyst as we go forward, that they are going to be, and the nice thing about cash flow is you can't hide that. That's going to hit equity, and it's not subject to estimate. At the end of last year, in supporting our thesis that the cash flow is accelerating, Kimra announced that they were, that they had a good year, that they had excess capital, and that they were going to make a 20 cents a share special dividend as a return of capital, which went X today. And that was a very nice action and supports our thesis of the conservatism and the integrity of management. They've also committed to paying 9 cents a share in dividends for both the first and second quarters. They paid 9 cents a share in each quarter last year for a total of 36 cents, which was, going forward, if we're getting that rate, you're looking at about a 11.5% yield. So we don't see a lot of downside here. It's if book value is representative of the economics, you're getting a stable security that has a 12% yield. If book value is, as we believe, materially understated, you're getting a 12% yield, and you think you might have 50% upside, 25 to 50% upside on the book value growing over the next couple of years. So we see a lot of really nice outcomes, and we have a very hard time seeing how you can get your face torn off. It's there's no financial leverage of note. There is the underlying securities are pretty stable, prime Alt-A collateral. It's collateral that we feel very comfortable with on the underlines, and we believe that you have management that is doing a good job. So that is that's how we see it. So hopefully that gives some insight not only to Kimra, but also to how we look at investing.
Chris, thank you very much for these detailed remarks on Kimra and your differentiated investment view here. Really enjoyed it, and want to refer everybody in the audience with questions to get in touch with us in the online conference area where we can facilitate the Q&A, or get in touch with Chris directly with the contact information shown here on the slide. Chris, I have a few questions myself. If I may, just on one of the slides, you show that 4.7 billion of value for the total portfolio, and 1.7 billion of value for the non-agency portion of it. I was just curious, that is your estimate of the sort of implied value of that portfolio per the reported equity value of the company. Is that correct?
Yeah, that's exactly right, Oliver. It's it's sort of an artifact of these securitizations and how GAAP forces them to account for them. So effectively, they securitized off through these 10 securitizations. They securitized off $4.1 billion in what they're measuring as fair value as of June of 2013. However, they have sold off the majority of that on issuance. But GAAP accounting forces them to consolidate these variable interest entities onto their balance sheet. So they record the fair value on the full face amount, as well as the liabilities associated with the full face amount of the securitization trust, even though they have sold off a good portion of those securities and the debt is non-recourse to them. So there's some adjustments to their GAAP accounting that needs to be made. Now, why we have an estimate in for the retained portion, so it's basically, we estimate that of the $4.1 billion in assets that they show as being in these variable interest entities on the balance sheet, we believe that about 1.75 billion of that they've actually retained. And they will give that number out. So we have that number for December 2012, but they didn't give it out for June of 2013 yet. However, one of the complexities of their financial statements is that for all the other categories, they will give you information about the notional or principal amount, the cost basis, the coupon, the yield, where they're recording it, fair value, and they don't they give it for the securitizations as a line item for the 4.1 billion, but they don't give it specifically for the amount they've retained. So that's why we have to make some guesses there, or educated guesses, hopefully, as to where that portfolio. We know what their fair value is typically, but we have to guess as to what the characteristics might be based on the qualitative information we've received from them, where they said, we sold off the prime, we've retained the subordinated, the mezzanine, we've retained some interest only, and so that's where we have to go in and try and add value through our research.
And then as we go on to the slide here showing the valuation that you have for this portion, and in fact for the whole company and the various securities, you've broken it out nicely here on this slide. Just want to make sure I understand that. So realizing this is as of the year end 2012, but that 1.7 billion as of June 13, that has now become, in your low estimated value, 2 billion, and then in the high estimate 2.25 billion, correct?
Yeah, that's exactly right. Yeah, we're talking about line 5 on the valuation slide, and so that that 1.7 billion that they are valuing it, we estimate that they're valuing it at June 30th. We see that they valued it at $1.5 billion in December of 2012, and we think the upside, there's upside from there for, as you mentioned, 2 to 2.25. I mean, clearly, as you can see from the slides, the big drivers of value are going to be, on the senior interest only, the subordinate, and the RMBS transfer to the securitization entities that they've retained. That's where we think there's going to be meaningful upside. I should also state, going back to the last question, Kimmer reports their GAAP book value. They also report what they call their economic book value, which is them subtracting out the securitization assets and liabilities that do not pertain to them. So for any investor looking through Kimmer's financial statements, ignore GAAP book value. Just focus on economic book value. It's a lower number, but it's actually representative of their economic interest.
And Chris, if we just stay here with this slide for a moment, where you provide the valuation, I'm curious, can you just remind us, so the senior interest only, subordinated, and the retained portion, How do those come about in an origination? How do they end up on the asset side of the balance sheet?
Sure. Well, the securitizations are sort of, a vehicle for investment bankers to try and take a pool of assets, cut it into smaller pieces, and move things around in the hopes that you're selling products that are more tailored to where the demand is in the marketplace, and the hopes that you can sell the pieces for a little bit more than what you started with. So basically what would happen is there was demand. The reason these securitizations were able to be effectuated is there was demand in the marketplace for, non-agency, prime, all-day paper. That if you think about at the time these securitizations were issued, 2008 through 2012, there was not a lot of new issuance of jumbo securities. There wasn't new collateral like this coming on the market. So they were able to sate demand in the marketplace by taking the securities that they had bought at advantageous prices and repackage them and sell them off. And effectively for them, it was a financing transaction. So it allowed them to take the pool of simple jumbo mortgages, 30-year fixed mortgages, and carve them up and say offer, a smaller piece of securities, which are tranches, which were, 30-year fixed mortgages, offer them at somewhat of a lower coupon, and they sold those off, and there was high demand for those. In fact, the demand for those was, high enough that it allowed them to basically pay for their recover their cost basis, and they were retained with the other pieces for free. And so the other pieces that are left behind are pieces that would get paid after those prime pieces. Those prime pieces have sort of a first claim and on the cash flows that come in as everybody pays their mortgages each month. And then as those prime tranches get satisfied, then the cash flow starts coming over to the other pieces. And the other pieces are basically, created at the whim of the banker based on where they think the demand is. So they created some interest-only pieces where you have a claim to a portion of the interest payments that come in over time. And what's interesting about the interest-only pieces is that you have, as I mentioned before in the presentation, you have negative duration. So as interest rates go up, all things equal, prepayments go down, which means that your maturities are going to be, effectively extended. And under that scenario, you're going to expect more interest to come in because the life has been extended, and that's going to increase the value of, your present value of your cash flows. So that, we think, is going to be a very attractive security for them to be holding over the next couple of years, because we think that the values there should be very well protected on the downside, because we don't forecast interest rates falling. We don't have an opinion as to how high or how fast they might increase, but we feel very confident that directionally the downside is blocked off. And then the other pieces are just, sort of straight, the subordinated pieces are, not interest only. There's, interest and principal, but they get paid after the prime tranches get satisfied. So, the cash flow comes in, and it gets directed first to the prime tranches. A portion of the interest that is paid out goes to the interest onlys. And then once those prime tranches are satisfied, whatever's left then flows down to the subordinated tranches. And so, if you had a choice of saying, all things equal, what would you rather have? You say, well, gee, I think I'd like the prime tranche because I could get paid first. But again, attractiveness in these investments, as it is in any other investment, is going to be a function of And so the people that bought the prime tranches paid very dearly for sort of that rosy consensus of saying, hey, we know we're going to get paid. We feel very certain that we're protected here because we are, getting first claim on the entire pool of cash flow, yet our tranche is only a fraction of the entire pool. So we feel that because we have first priority claim, we have protection there. We're going to pay up for that. Okay, so that makes it maybe, in our opinion, a very attractive security to be a seller of, as Kimmerer was, not so much to be a buyer. Conversely, if you look at what they retained, all things equal, you say, gee, I don't know if I'd want the interest-only pieces, or I don't know if I'd want subordinated pieces. But again, it's a function of price. Their effective price for this, because of the securitization, where they effectively recovered their cost, they got these for, they were left with these pieces, sort of the secondary securities, the residuals of the securitization. They're left with them, but they can't hurt them, and their cost basis is minimal. So it's basically a free option to the upside for them to do the securitizations, recover their cost on the underlying pool of securities, and be left with a free option on the performance of the residuals.
And if I look on the slide, also just the contrast again, which I think is important to emphasize between agency and non-agency. So they do have, as can be seen here on the slide, that 1.8 billion of agency RMBS, and then offset by the liabilities. It's about 300 million of net asset value in your valuation. That's not as material, of course, as the agency side. Give us a sense of the non-agency side. Give us a sense of how the credit risk and interest rate risk plays into here, and to what degree one or the other is important with these various securities.
So on the agency side, you don't have credit risk because the government's basically, giving you a put on credit risk. So you're only exposed to interest rate risk. And frankly, as you can see in the valuation slide, while they're earning decent returns and have shown their adeptness over the course of the last few years in effectively managing the agency portfolio. And with the leverage, they're probably earning, low, maybe 10 to 13% return on equity on that portfolio, mainly driven by the leverage. And so it has contributed returns. We just don't ascribe it any value. So it's because it's not there for a investment purpose per se. It's there for sort of regulatory purposes, and as such, it's really more of a source of cash. And so, if you look at the portfolio on the agency side over time, it shifts around so much based on other opportunities that we just really don't feel like there's any insight in how you could value what they would earn over time, because we just don't know what the size of the portfolio is going to be over time. Typically, as they found, they're in the business really of generating returns through investing in non-agency, and so the agency portfolio then exists as a regulatory requirement and also a residual of, if they don't find opportunities in non-agency, I guess all things equal, they might put it in agency, and if they find more attractive opportunities in non-agency, they'll draw down the balance of the agency portfolio to fund it. And that's a very liquid portfolio of Freddie Mac, Fannie Mae paper, and we feel pretty comfortable, and they've shown the ability to manage that. So we don't ascribe any value to that. On the non-agency side, you have interest rate risk, but oh, and I should add on the agency side, they have historically had interest rate swaps to hedge out the interest rate risk there. So there's really, we view that as a pretty insulated portfolio. On the non-agency side, you have, I mean, technically you have interest rate risk. It's just not going to be the primary driver of your returns. Your returns are really going to be driven by credit risk. So, you know, what happens when interest rates rise is a little bit more complex on the non-agency side because, you know, you would say, well, gee, if rates rise, bond prices should go down. Sure, but in the case of mortgages, you know, if rates rise, it's because the economy is improving. If the economy is improving, it's because people have jobs and their housing values, you know, should expect to increase with employment. And if the housing values are stable to rising and people are employed, then your performance on the credit side of mortgages, all things equal, should be okay, right? And so, you know, we would expect that in a rising rate environment that because it reflects a improving economy, that the improvement on the credit side of the mortgages should dominate any interest rate risk on the non-agency side, and that it's a net positive. You know, where you'd lose on the non-agency side is if we go back into recession. If you know, and so you might have, you know, much lower interest rates than today, but you'd have high unemployment, you'd have falling housing prices, you'd have increased foreclosures and reduced recoveries on loss. You know, that's where we see the exposure. And while that would have a meaningful impact, or, you know, material impact, we just don't think the probability is significant of that outcome. But that's really the way that you could get hurt here. And it's because we think that is such a low probability event that we feel very comfortable with the reward to risk profile. You know, it's interesting. You know, we're attracted to mispricings, and you know that leads you to securities that tend to be either you know, unintentionally overlooked or actively avoided. And Kimra is a little bit of both. You know, because it's overlooked because it's you know, not a lot of people are really active in the space. The accounting's complex. You know, it's actively avoided because, you know, when I talk to people about Kimra, I'll get one of two responses. Either people say, I get it, and they're like, this is interesting. Or they look at you like, you know, you've suggested that they, you know, they take their entire net worth and bet it all on red at a roulette wheel. And that actually is a really, it's a really encouraging sign because we like the securities where when people, you know, when you discuss them with people, even professional investors, you get sort of that ugh reaction where people are like, you know, why would I want that? And that's the actively avoided. So, you know, there's a, you know, you could certainly create a point of view on camera that says, gee, it's a mortgage REIT, so it's a financial, it's complicated, it is, it's a black box. The accounting is complex. The financials are not current. The you know, this is a lottery ticket, and that is, in my opinion, completely false. And so the fact that you get that reaction from you know a few people tells you that there is a significant divergence between perceived risk and probable risk. And that's the type of mispricing that we're looking at. So, you know, a lottery ticket to us, it's binary event where, if all the stars align, maybe you win big, but if everything's not perfect, it might be a total loss. And maybe the factors that, determine whether it's one or the other are like entirely out of control and observation. That is a lottery ticket to us. This is not that. This is, again, what we view as sort of a closed-end bond fund trading at a deep discount to net asset value, which offers you an awful lot of protection. There's upside because of the price. There's upside because of the catalyst. We don't see any reason to think anything but highly of management's integrity and ability over the last few years. We see a number of catalysts and observable inputs in terms of being able to look, through the securitizations into the underlying collateral, see how it's performing on a monthly basis. We believe that the accounting issues are, immaterial on an economic basis and should be resolved. And so it's, Kimera is anything but a lottery ticket. Kimera is a situation where your downside's protected. You don't necessarily know how much you will get on the upside. You don't necessarily know exactly the timing of when that will occur, but it's very, very hard to envision a scenario where you would have a permanent impairment of capital on the downside, and it's very easy to see multiple scenarios where you'd have significant upside, and that's the asymmetry in the reward to risk profile that really attracts us.
And Chris, when you say that you view this as a bond fund, closed-end bond fund trading at a discount, in the context of the valuation here on the slide where you show a low value that sort of provides 25% upside from the recent share price to a high value that provides about 50% of upside, help us understand how those estimates refer to just closing that discount versus then kind of compounding your capital over time. How does the two components of a return to an investor of closing the discount versus that book value is growing over time as well?
Well, we've really viewed because we don't have great insight into the reinvestment opportunities. So we're really looking at this portfolio from a runoff perspective. Now that's what the valuation relates to. Now that said, management has shown its ability to opportunistically find attractive areas in the non-agency mortgage space to deploy capital. What that opportunity looks like going forward, I don't have great insight into that, and so we haven't really factored that into our calculations. I would think that there is further upside to our estimates, if they get the issues, with the accounting behind them, and they're able to attract new capital. I think there's some things that they could probably do, but frankly, they've been closed down on communication since the accounting issues surfaced in the third quarter of 2011, and so it's hard for us to speculate as to where they're finding opportunities now. We can look at where other managers are finding it, but frankly, we expect that once they get these issues behind them, that the market probably will be more efficient in pricing what their future opportunities are, and as such, we haven't made that a component of our valuation. We're really looking at the portfolio as we see it today, which is in flux. I mean, they are making changes from quarter to quarter, but we're looking at that really more as a runoff perspective in terms of the high end on the upside, and the low end on the upside is really more relating to our estimate of what it's Annaly or any other party that would come in and acquire the portfolio.
And actually, in that context, I was also curious if you could speak a bit more broadly about the ownership here. You mentioned the 4% ownership by Annaly. Are there any other engaged shareholders here who, especially in the case of a bid from Annaly, could make sure that Annaly pays a fair value?
Yeah, I mean, there are other investors of note in the stock. Lee Cooperman at Omega, who we think very highly of, is a 6% holder. Pine River, which is a very experienced fixed income investor, owns a little over 1%. Larry Robbins at Glenview owns 1%. I think it's there are enough investors in the stock that I think are educated as to the situation and the underlying value, and I think that offers some insurance that against a lowball bid from Annaly, but we try not to put too much reliance on seeing other names in the holders list. Everybody else is operating under their own actions, and we can't rely on anybody else to be our savior. But certainly there are some other notable investors in the name.
Great. Well, we're going to have to leave it to that. I would encourage once again anybody with further questions to get in touch with us or with Chris directly. And Chris, to you a special thanks, and look forward to monitoring the progress of Chimera and your investment case on it. Thank you again so much.
Great. Thank you.